In this course, we are going to discuss about index divergences. The three US indices are positively correlated. They move in the same direction. This means that if the Nasdaq is bullish, so are the S&P 500 and the Dow Jones. Sometimes, two of the three indices start reversing before the third one. This last one resists to the reversing move and trade in the opposite direction to take liquidity before joining the other ones. This will cause a divergence formation between the three indices. Two indices will follow each other, and the third will be slow to react. Never all the three indices at once. This is called leading index and delayed index. While Nasdaq and S&P 500 are making lower lows, Dow Jones is making a higher low. These two indices took the liquidity resting below the swing low when the Dow Jones didn't. Therefore, we have a bullish divergence and we expect the price to go higher. In this example, while S&P 500 and Dow Jones are making a lower high, Nasdaq is making a higher high. This last took the liquidity resting above the previous swing high when the other two indices didn't. In a bearish trend, we expect the price to drop down. Misconception. We cannot take positions only if we have spotted a bullish or bearish divergence between the three indices. It's just our trigger to take long positions when the bias is bullish or short positions when the bias is bearish. Otherwise, we have to wait every time for a high probability setup and endorsing our position with divergences. So let's see some examples from the chart to clear up things for you. We have in this example a bearish divergence between the three indices. Nasdaq made a momentum bullish move in this area of liquidity, while S&P 500 and Dow Jones didn't. So this is not a bullish reversal of Nasdaq price, it's only a grab of liquidity. The three indices dropped down just after this move. As smart money traders, we have to wait for a high probability setup creation before taking a short entry. In this example, we have a bearish break of structure first, so we select this order block as our point of interest. We have also this fair value gap below the order block. Price came back to premium level before dropping down. So we can take our short entry at the level of this candle and target the last swing low. In this example, we have a bullish divergence. Nasdaq made a higher low, whereas Dow Jones and S&P broke the previous swing low and made a lower low to grab sell-side liquidity sitting there. As in the previous example, we wait for a setup confirmation before taking a long entry. First, we select this order block as our point of interest that leads to this break of structure. Price retraced back to the discount level here before continuing higher. So we'll put a long position here, stop loss below the order block, and we'll target the buy side liquidity. So our take profit is hit. Delayed index divergence. When we are trading a delayed index that took the liquidity, Nasdaq for example, and we spotted a bullish divergence with US 500 and US 30. We have to wait for bullish change of character before taking a long entry. When the bullish break of structure occurs, we get more confirmation of bullish price continuation. Same thing for the bearish divergence. If we are trading a delayed index and we spotted a bearish divergence, we have to wait for change of character as well. When the bearish divergence occurs, we have more confirmation of bearish continuation. So let's move on now to the chart to see some examples. In this example, we are using 5-minute Nasdaq chart. We have a bullish divergence between the three indices. While Nasdaq and US 500 made a lower low, Dow Jones made a higher low. If we suppose that we are trading Nasdaq index and we spotted this bullish divergence, we have to wait for a bullish break of structure to get more confirmation. Once we have this change of character, we define this order block as our point of interest. We'll use our Fibonacci retracement tool to identify the discount level. So we wait for price to get to the discount level and to fill this small fair value gap. Before taking our long entry. We'll put our stop loss below the order block and we'll target the buy side liquidity level. And our target is hit. In this second example, we are using 5-minute Nasdaq chart as well. This last is the delayed index that made a higher high, while the two other indices are the later ones. They start reversing before and made a lower high. We wait for Nasdaq's change of character before taking a short entry. So first we have this break of structure with the momentum. So we select this order block as our point of interest. We have these fair value gaps as well below the order block. So if we take the Fibonacci retracement tool from the swing high to the swing low, we would find that the price came back to the premium level before continuing lower. So we'll put a short position here, stop loss above the order block, and we'll target the sell side liquidity at the level of the swing low. So the price hit our take profit.